Hi, I'm Giselle Roux. Welcome to the Inside Network.
Today we're joined by David Simon, the co-founder of Potentum Partners, which has combined the expertise of the private equity investment team from the Future Fund to do things, I think, a little differently. David, would you like to explain what your background is and what's led to the foundation of Potentum Partners?
Sure, thank you, Giselle. So I've spent my whole career in private equity. I've been in the market for close on 20 years now. And I started my career doing small growth and buyout deals in New Zealand and Australia for a captive bank fund before joining the Future Fund in 2008. So while I was at Future Fund, alongside my partner Steve, and later my partner Jasmina, we spent 10 years there building a $20 billion private equity portfolio for the Future Fund that spanned venture through to buyout and co-investment in all of those sectors. A global portfolio, but managed from a single office in Melbourne. So 2 years ago, we decided to spin out and form our own firm, and Potentum Partners is seeking to provide some of the same services that we were providing to a single client at Future Fund to a small handful of institutional and family clients in Australia and around the world. So each of those investors doing something a little bit different, investing in separate accounts, co-investment heavy, really trying to lower the cost of access to private equity as an asset class.
So we're all too familiar with changes of behavior in COVID that have been very transparent to us. Does that lend itself to certain industries being more appropriate under private equity while they go through some restructure to deal with the change?
Yeah, I think many companies face that in any type of disruption. There are certain types of change and restructure that make a lot more sense in private hands. If you're asking specifically about impacts that have happened around the pandemic and the particular disruption there, it's a tricky time. It's difficult to see through the changes that are happening right now and understand what that means for the future of those businesses and how easy it is to extrapolate those trends going forward. So I kind of think of those opportunities in different buckets, right? So there's a bucket of investments where there are existing trends that have been brought forward by several years. And so e-commerce, greater penetration from that. I think we got 3 or 4 years of penetration increase in a single year. Working from home, the Zoom calling, the network infrastructure that needs to go alongside that, and the network security that needs to happen when you've got people working remotely on different networks all the time. Now, some of those are going to give up some of what they've brought forward. I can't imagine that a year from now we'll all be doing as many Zoom calls as we are now. But I don't think they'll give all of it up. So, I think part of the reason people weren't Zoom calling more earlier was that everybody didn't know how to use it. So you'd organize a meeting with someone and they would struggle to get onto the call. That's all gone. Where that friction has disappeared now. We've all cleared that hump together. So, I'd expect they'll give up some, but continue to be a fair level of video calling. Some groups won't give it up at all. So when I think about network security, chief technology officers went from worrying about remote working for some small portion of their employees, and overnight that went to 100%. So it became a big issue. They've been focused on it, and network security businesses have had a tailwind as a result. That demand, they're not going to take that security out when we get to the other side of this. And in fact, I think if you're a CTO now not focused on this as an issue, you stick out. So, I'd expect growth to continue at an accelerating rate for that. We discussed before the boredom economy, and a large portion of the populace sitting at home bored and trying to find a way to fill their day. There are probably some e-commerce plays and definitely some consumer apps that have relied on that and have had a real tailwind, and I expect that will disappear. We're also a little worried about margins in some of those businesses. I'd expect as we come out of the pandemic, there's going to be a feeding frenzy for users. So people who are using Google or Facebook ads as their main customer acquisition approach might find some real pressure coming out the other side of the pandemic.
Is always the perception of a large amount of capital in private equity chasing investments, and reflecting on what you've said in terms of things like network security and so on. Can you, how do you judge which ones you should support, and do you have any examples in that field?
So we try not to go chasing thematics as much as we are chasing, companies doing interesting things. So we're much more of a bottom-up investor than we are a top-down investor. That said, sometimes thematics help us decide where to spend most of our time, and we look at that a little bit. I mean, Giselle, you'll be familiar with something called the hype cycle, right? Yeah, a new idea comes into venture capital or just the economy overall, and everyone gets super excited about it until they realize it's harder than they thought. And then everyone decides it's a dead end. And it's at that point that you start to see a really interesting slope of growth where people are focused on where it works, where it doesn't, and really making and creating real businesses. That's where we tend to spend most of our time. A good example of that would be clean energy, green energy. So green technology was a huge fad a decade or so ago. Lots of money was raised to go chase that opportunity. A lot of it was burned. Some of it has survived and is now performing quite well. We've gone from it being the easiest thing to fundraise for to being impossible to fundraise for, and now we're starting to see some real advances there. So, the cost of photovoltaic energy has dropped 90% in 10 years, and batteries have dropped somewhere between 70 and 90% in 10 years. So now there are real scale businesses being built there that make a lot of sense. And so, we see that again and again, and it's about a matter of picking your spots and trying not to get caught up in the hype. One example right now would be AI and machine learning, where there was a lot of hype, and we've probably come down the other side of that. I'm not sure whether we're at the bottom of that hype cycle yet, but for a period, people were chasing anything that had AI or machine learning attached to it. And now, like us, everyone's very focused on, okay, here is a business that is solving a real problem and has a real business model attached to it, where you can see a sensible way to make money. So I think that's how we tend to focus on it. Because we're a bottom-up investor, we screen most of the hype. If there's not a real business there, we're not engaging.
So it follows on to asking how you go about valuing companies which have no profit, limited negative cash flow, and if I may ask, how you judge between company metrics and the management of those, because there are two differences, aren't there? There's somebody managing the business, and then there's somebody just running the numbers.
Absolutely. So, when in the specific example of a business which is high growth but unprofitable, it's in some ways it's the same as valuing any business. You're trying to see a path to what the business could be, and working backwards from that to what do I need to believe in order to make that happen. In the specific example of those businesses, I think looking at unit economics is the main path that we use and other people use. It's about understanding what it costs to acquire a customer and what that customer is worth. That last piece is trickier than it sounds. There's a lot of assumptions built into that, but that's probably the best way to do it. Those businesses that have attractive unit economics, they can slow down their growth if they need to, and move to profitability or closer to profitability, which helps. And also, when you're investing in these businesses, it's useful to understand how much capital or how often they will need to raise in the future in order to get to profitability. Because until they get that, even though there's no debt on these businesses, if you're dependent on a future capital raise, then if capital markets turn south, there's a real existential risk for the business. So that's a key to understanding the metrics. In terms of management, that's another key piece. So what do I need to believe in order to get there is fairly critical. So we look for founding teams that have path critical skill sets. So if it's a business really dependent on acquiring customers well, we like to see someone with that background. If it's a very technology driven business, we like the founders to have that skill set. But they need to show an ability to attract talent and retain talent in that business. And it's critical for the future growth of those businesses.
There's a whole variety of ways you can improve businesses in private equity, restructure them, the roll-up methodology of adding on more businesses, startup capital. Can you just differentiate for us their risk return profiles? Are they very different? Should we look at them all, think about them all differently?
I mean, they're definitely very different. And we've been talking about companies so far, but the main way that investors access these opportunity sets is through funds. And so funds have some of the same risks across all of these strategies, but also some different risks specific to these strategies. So when I think about restructuring opportunities, typically it's a cost out opportunity. So it's a business that has been run poorly and is too much cost. And if you can pull it out and make the business profitable, then that's interesting. But there's a bounded upside on that, right? Like you can't get past 100% margins in a business. And so you can only make so much money there without returning the business to growth. I think of opportunities there in two buckets. And the one is fixing broken businesses. So you have management, which is poor. That's not a cyclical thing. It's present through the whole cycle, and you can buy those businesses and fix them. It's very resource intensive, and so it doesn't scale that well. So an investor in funds that are doing that needs to be very wary of funds that are increasing their funds under management rapidly, because the skill set of the team and the bandwidth of that team won't keep up. The more cyclical opportunity there is what people call buying good businesses on bad days. So businesses with broken capital structures, but capable teams and a good business model. But that's really cyclical, and it doesn't fit really well with a private equity fund structure. So people tend to raise a lot of capital in advance of an expected recession or a problem like we saw earlier last year when the pandemic hit. But if there's not a big recession off the back of that, or if it's a short-lived and quickly recovered recession, they've still got your money and they're still going to spend it because they're incentivized to do it. They'll spend that on their plan B, and that plan B often might not be very good. So we're wary of pursuing that opportunity set for a traditional private equity fund structure, and we much prefer the restructuring bad businesses where the managers are sensible around their fund size. On the roll-up piece, different set of risks there. You're generally buying a high-quality small business and then looking to bolt on other things. What we look for there is fund managers that pursue a strategy where they've got multiple levers for growth. So you want to see a manager that is investing in businesses with a growing end market. There are greenfield opportunities as well as the bolt-ons, and most importantly, they're integrating those businesses very well. If your strategy is, we're just going to buy the bolt-ons at 7 times and sell a platform at 12, that works until someone else starts doing the same thing, and suddenly you're paying 9 or 10 times for these businesses. And if you're not integrating them well, you're adding head office costs, but not reducing costs in these bolt-ons, and suddenly you're buying for 12 times, and your whole business, the whole model breaks down. So again, it's very heavy lifting, it's very resource intensive. Be wary of managers that are increasing their fund size rapidly, because it's difficult to grow a team that can do that at the same pace. Startups, again, individual companies, very, very risky. Funds, much less so, because they tend to be very diversified. In a restructuring or a buyout / roll-up type strategy, there might be 8 to 12 to 15 companies. You might see 40 to 100 in a venture fund, depending on the size of that venture fund. Most of those deals will return less than capital. It's a real outliers business, and so they're looking for the 1 or 2 deals that can return the whole fund. It's also an outlier business in terms of the performance of the managers. So like if you carve out the last 5 years where there's been a massive tailwind to this market and a lot of people have made money, it really is a small set of the managers that are delivering reliable returns in this market. So I would say highest risk, some of that risk can be to how long it takes to generate the return. They tend to be pretty stable on the multiple of return to a fund, but the IRR or rate of return can vary a lot depending on what exit markets are like in 5 to 10 years' time.
We often hear or see headlines of very successful stories in private equity, presumably to allude to your previous answer is there must be a fair amount of failed investments. That's the nature of the beast. How many investments, so in a typical fund structure, you mentioned venture capital, it's a very on and off switch. Mm-hmm. What about the others? When they don't provide an investment return, what actually happens to that entity and who makes the decision to close it out?
Sure. So in non-venture, non-growth, so you're talking sort of control buyout type opportunities, you'd expect around 30% of the capital to return less than 1 times, and maybe 10 to 15% of that you'll lose all of the money in a given deal. So, you've got to be hitting some pretty strong outcomes in some of the other deals in order to make that make sense. So you want a lot of capital above 2 times. You want something, at least one deal above 3 or 4 times in order to make an acceptable fund return in buyout. Now, each of those investments are non-recourse to the fund, right? So they're their own standalone equity investment. The decision to wind those businesses up tends to be in the hands of the debt holders. Most buyout strategies are using quite a bit of debt. Even if it's only 50%, if the business struggles, it's really going to be the lender that decides when and how to wind that up.
And you've been involved in businesses, or you've seen the repercussions of when businesses are closed down and therefore, you're still stuck in that fund, aren't you, until completion?
Right. So, but it's expected. So at least a couple of those deals will fail or not deliver the return that you had hoped. But as a portfolio, you'd expect a stronger performance from the rest of it. Part of the difficulty, and maybe you're getting to underperformance at the manager level, part of the difficulty in private equity is that your money is tied up. So to the extent that a manager is really underperforming and say the fund looks like it's going to lose money and investors have lost confidence, it's possible but very difficult to wind that up. Generally, funds have terms around no-fault divorces and things like that will require the consent of 90% of investors. So you've got to find out who those investors are and convince them to fall in line with your plan in order to fix that. And more often than that, what will happen is that the manager will find someone to buy into that fund in a GP-led secondary and provide you the option of, you can take 80 cents on the dollar now or stay along for the ride for the rest of the fund life.
Private equity has got vintages of various forms of return. In the current environment, where would you see the return profile sit based on your experience in terms of different vintage returns over time? Are we in an average or a high potential return environment?
It depends on whether you're talking about new investments or existing investments. So existing investments that are anything even slightly technology related are performing very, very well. Haven't been impacted at all by the pandemic and continue to do well. Managers that have exposures to restaurants, travel, entertainments, especially with debt on them, are struggling. Now, that said, I think it could be a very interesting investment opportunity for those strategies if the businesses survive through, or for new capital deployed into those sectors from now. Generally, on the buyout side of things, forward returns are at least partly a function of prices paid, and prices are pretty full in most sectors right now.
David, thank you very much for those insights.
Thank you, Giselle.